doctrine of ultra-vires, doctrine of constructive notice, doctrine of indoor management. Like that, a well-established case law is a doctrine. Now, what is this doctrine of ultra-vires? Now, memorandum and articles of the company becomes the basic document. Any outsider dealing with the company has to simply enter into contract with the company only as per the provisions of the memorandum articles. The members also has to deal with the company only as per the memorandum articles. So also the board of directors should not exceed their powers whatever is given in the memorandum as well as the articles, particularly the articles of association of the company. Ultra-vires means beyond the scope of powers. So, memorandum gives you what the company can do, what the company cannot do. It puts the limitations, it gives the scope of powers and also limitations of the powers. Therefore, it is very, very important that the board of directors must restrict all their objectives only with that of the memorandum and articles of association of the company. Fine. Now, this concept of ultra-vires was very clearly defined in the Ashbury Railway Carriage Company versus Ritchie case. Now, in this case, the government of Belgium gave a contract for supply of railway coaches and engines, rather tramways, coaches and engines to the company called Ashbury Railway Carriage Company. Now, after that, the Belgium government thought, since he is already manufacturing this coaches and engine, why don't he himself lay down the tramway lines or at least make the construction of these tramway lines? Why doesn't he himself do it? That was the whole idea. So then this Ashbury Railway Carriage Company was quite happy to receive this contract. So he checked up his memorandum. Can he do this object of construction of these tramways, tramway lines, and also financing these tramway lines? He found there were 4 words. He can do the business of mechanical engineers and general contractors. He can do all this business of mechanical engineers and general contractors. Then he told, yes sir, I've got in the objects. But the court did not agree. The court elaborated the concept of ejusdem generis. What is this ejusdem generis? When a particular word cannot be comprehensively defined, it can be only explained with a set of words, and we want to put an end to the set of words by a general word. The general word must not be given elongated meaning. The general word must be given a meaning relevant to the preceding word. For example, let us say the sentence is like this. You can keep and grow domestic animals, including cows, buffaloes, donkeys, goats, sheep, dogs, cats, and the list goes on. I want to put an end to the list and other animals. Now, and other animals, does it include a lion and tiger? No. You should not read the word and other animals separately. You must read it with the preceding word. So definitely and other animals means domestic animals only. Therefore here the court said, if you can do the business of mechanical engineers and general contractors, it means mechanical engineering related general contractors. It's not any general contract. It is not financial contract. It is not civil contract, any general contract. You should not use the word like that. You should not give a separate interpretation. Therefore, the court said you cannot do the business of construction of this railway line, the tramway lines, and finance them. So this was the idea behind. This is where the court said ultra-vires. Because a company is a legal entity, they cannot do anything and everything in this world. Their objects are very clearly defined in the memorandum. So the board of directors, the company has to restrict all their activities only to this memorandum. So this was the concept of ultra-vires, where if you exceed the powers, it is beyond the scope of memorandum. So you should not do that. Now, what are the consequences of ultra-vires? If you have done something more, then what are the consequences? Consequence of the ultra-vires acts. 1. Void and unenforceable. void and unenforceable. Void. Void means it has no legal effects. It is as good as not entering into contract. For example, say for the fun of it, say Reliance Industries Limited has entered into a contract for 20 crore project to set up a paper plant. Later on, the company secretary comes and tells the managing director, sorry sir, we have started this paper plant and you already spent about 10 crores of company's money. We cannot do this business. Now what shall we do? So what are the first consequence? Void. It is as good as not entering into contract with the outsider in regard to 20 crore paper plant. Void ab initio, right from beginning. No legal rights will arise and it has no legal effects. It is as good as not entering into any kind of contract. Next, no ratification. It means what? If all the 36 lakh shareholders of Reliance Industries Limited come and stand in front of me and raise their hand and say, okay sir, by mistake the managing director has done, we are agreeable to that. What? You cannot agree. The ultra-virus transaction cannot be ratified even by the whole body of shareholders. What does it mean? Once ultra-virus, it continues to be an ultra-virus only. Third, injunction. It's not injection, injunction. Now, any shareholder is entitled that whatever the company does must do it within the objects only. Therefore, if the company tries to exceed the object, he can go to the court. Any individual shareholder or member can go to the court and get an injunction order, stop order. Injunction order, that is stop order, restraining the company from proceeding with the Ultra-Virus Act. Restraining the company from proceeding with the Ultra-Virus Act. Next. Fourth, personal liability of the directors. Any member can maintain any action against the directors to compel them. That's all. Since you have exceeded your authority, the directors must read and understand the memorandum and articles. You are not done, so you will be personally liable on the contract. My God. In the given example, Mukesh Ambani alone will be liable for 20 crores to the other person. The company will not take any kind of liability on themselves. So they have to restore. So in the given example, this 10 crores, come on, Mukesh will be personally liable. Then the next consequence, breach of warranty of authority. The relationship between company and director is that of principal and agent. So agent, when he exceeds the authority, he shall be personally liable. That's way the directors are liable. Ultra-virus acquired property. Hey, very interesting. Okay, now in my given example, let us say the supplier has already supplied 20 crores worth of property. Now what will happen to the property? Can the supplier take back? No. Surprisingly, no. Once ultra-virus, always ultra-virus. The ownership passes to the company. So company has a right to keep it. Very interesting. Even though ultra-virus transactions are void, if the company has acquired them, it has a right to hold the property and protect against damage by other persons. No other person can say, no, you also acquired this property, you are not the owner. Nothing doing. Even though it is ultra-virus, I am very much the owner of the company. Therefore, I can take all these steps to protect the property. So this is, you can get a question. What is ultra-virus transactions and what are the legal effects of ultra-virus transactions? You must write this much. I will just move on. Next, doctrine of constructive notice and doctrine of indoor management. See, we should really understand the depth of the meaning of this doctrine of constructive notice. We'll go deep into this. What is this doctrine of constructive notice? I'll take one example. And then we'll go into the subject. One uneducated fellow, he had a lot of money, say around 1 crore. He started a cement dealership business, putting a working capital of 1 crore. Now, this uneducated fellow, he went to a construction company and he met the managing director and told him, sir, I heard a newspaper advertisement that your company wants to supply cement on credit for about 1 crore rupees. So I would like to participate in your tender. Then the managing director told, oh, welcome, very nice, very kind of you, please sit down. Now, what is the quotation? Oh, this is the quotation. Very good. So I will give you the contract. So he was about to sign the papers. Now this uneducated fellow, not much educated, he took the memorandum articles and he asked him, and the MD told, sir, in memorandum articles I am authorized to sign such a contract, but only thing, since it is more than 50 lakhs, I have to take board approval as well as the shareholders approval. Then what about the approvals? MD said, I have taken it. Then this outsider said, come on, please show me the board resolution and shareholders resolution. One certified copy was given to him. But the outsider was very, very apprehensive. He said, come on, what is the guarantee that board meeting has taken place? What? You mean to say you will show me all the board meeting, I have to show all the board meeting held documents? Yes. Please show me the minutes, sir. Then he saw the minutes. Very good. Then what is the guarantee the signature of the chairman is real signature? Huh? Then, sir, please check up the previous signatures. Okay, fine. What is the guarantee this board meeting was really held? Huh? What is the guarantee? Then he said, I'll see the attendance registers. Then they showed the attendance register. Then he asked, what is the guarantee that this attendance register, the signatures belong to that of the directors? Okay, then what is the guarantee? These are all the directors of the company. Come on, please show their appointment letters. Like that, he put some 45 questions. The managing director has cried by the time 10 times. He did not cry further because he had no strength to cry further. Then he called for general meeting documents, all that. And in the end, after 2 hours of discussion and seeing about 50 plus documents, he now says, thank you very much. Okay, you can sign the contract and give it to me. Now, I have not exaggerated anything. Word to word, what I told you is doctrine of constructive notice. Of course, now the doctrine of constructive notice is not there. It is replaced by the doctrine of indoor management. That's another thing. I'll come to that. So what is this doctrine of constructive notice? This doctrine says, hey, look, this is a legal entity, a company. So the company is run by the officers of the company. The company has to be run with the documents called Memorandum and Articles of Association. This Memorandum Articles of Association is available for inspection by any outsider on payment of fees. If the company does not give the copy, you can get it from ROC office also. They are public documents. So the outsider who is dealing with the contract should read the memorandum and articles. Whose duty? Outsider's duty to read the memorandum articles. He should not only read the memorandum articles, he must ensure that whatever contract he deals with the company, whose duty? Outsider's duty to ensure that whatever contract he deals with the company, the officers of the company has got powers as per the memorandum articles. And whatever procedures are given relating to internal management, it is the duty of the outsider to ensure that the company complies with the internal management. So, this doctrine prevents any person from alleging that he did not know the provisions of memorandum articles. So, it is the duty of outsider to ensure all the internal procedures are strictly complied by the company in the contract which he enters. If the company does not comply the internal procedures, who will suffer on the contract? The outsider will suffer on the contract. Therefore, in my given example, what this uneducated fellow did, nothing wrong. When it is written in the memorandum articles, MD can sign such a contract after taking board approval and also taking after shareholders approval. After taking board approval also, after taking shareholders approval, it is the duty of the outsider to ensure such an approval was given. That is why he verified that whether really board meeting has taken place, whether general meeting has taken place, whether there was a quorum, whether this resolution was properly passed, all that he ensured, nothing wrong. So this is the doctrine of constructive notice. So outsider has to be very careful because he is dealing with a legal entity, not that any person on behalf of the company will sign the contract and give it to him. This doctrine of constructive notice. There was one example where it was written in the articles that any document, any particular mortgage deed has to be signed by managing director, secretary and working director. When the mortgage deed was executed, only the secretary and working director signed it. The MD did not sign it. And the court said, you are to suffer. Mr. Because you should have consulted the memorandum articles. No doubt, you gave the money in good faith, all that is there, mortgage deed was executed and all, the mortgage is nevertheless invalid. So this is the doctrine of constructive notice. One more example, it was written in the articles very clearly that any check issued by the company should be signed by at least 2 directors. Then it is the duty of the outsider to ensure that the check is so signed and the signature belongs to the directors. So this doctrine protects the company, the doctrine of constructive notice. So in short, since the company is a legal entity, that all the internal procedures, rules and regulations be followed when the company enters into contract with the outsiders, it is the outsider's duty to verify whether the company has complied with the internal procedures or not. Right. Now this doctrine of constructive notice proved too inconvenient for business transactions. It was replaced by the doctrine of indoor management in 1856. 100 years before the Companies Act 1956, in the Royal British Bank Turkhan case. Today you have got 11 lakh companies. Where will you find time? How will you verify all these documents? Okay, for fun I told you, you went to the managing director and you asked 1,000 queries. Who will show all the documents? No. This constructive notice is replaced by a beautiful doctrine called the doctrine of indoor management. In the Royal British Bank Turkhan case. As per this doctrine, listen very carefully. Any person who deals with the company, having satisfied the proposed contract is not inconsistent with the memorandum articles, he is not bound to inquire into the regularity of the internal proceedings. He is bound to presume that the provisions are being complied and observed by the officers. What I am saying? Hey, when the outsider goes and deals with the company and enters into the contract, you must read the memorandum articles, no doubt about it. And you should follow whatever is stated in the memorandum articles. That first point is correct only. But the second point, it is not the duty of the outsiders to verify whether the company has complied with the internal proceedings or not. So in my given example, it is not this uneducated fellow's duty to verify whether board meeting has taken place, whether general meeting has taken place, all that he need not verify. The moment the board resolution, general meeting resolution is given to him, he can presume that the board meeting, general meeting has held. See, I am not using negative language. I am not saying that go to hell. I am not bothered whether you hold the board meeting or not. I am not talking of that. The outsider can presume that the board meeting and the general meeting has taken place. Beautiful doctrine. Today, outsider is able to enter into hundreds of contracts because of the doctrine of indoor management. That's all. So, once you can reasonably prove that the officers of the company, all that they are representing the company, fine. Tomorrow it turns out some of their internal rules they have not followed. Who will suffer on the contract? The company has to suffer on the contract. Therefore, the outsider is protected in the doctrine of indoor management. So, it is not the duty of outsider to see the company complies with the internal regulations. Now, what happened in this Royal British Bank Turkhan case? A guy called Turkhan, he went to the bank and borrowed, and the bank issued bonds. Bonds is something like unsecured debentures. So he issued some bonds. He invested, say, about 10,000 pounds. It's a British case. Then the managing director gave the bond and told him, please come after 7 years. I'll pay double the money. After 7 years, Turkhan went away. But it was written very clearly in the articles that managing director can issue such bonds only after taking general meeting approval. Turkhan presumed that he has taken the general meeting approval, so he took the bond and went away. When Turkhan came back after 7 years, there were another managing director and this fellow refused to make the payment. He said the old managing director who issued the bond has issued the bond without taking general meeting approval. Turkan said, I am not responsible with all this. So the court agreed with Mr. Turkan, stating that the internal procedures, whether they are complied with or not, it is not the duty of outsider to verify. The outsider can presume that internal procedures have been complied with. So this is how the doctrine of indoor management came into effect. Today, we are all very happy because the outsiders deal into company with thousands and thousands of contracts on daily basis. Therefore, beyond a particular stage, your internal rules, your internal procedures, how can we verify? But your procedure should be as per the memorandum articles. Once as per that it is done, if something goes wrong in the internal procedures, company has to take the responsibility, and thus in this doctrine, the outsider stands protected. Next. Exceptions to the doctrine. My God, back to square one. Exceptions to the doctrine means what? Back to square one means what? The company is protected. Outsider is not protected. So some basic precautions the outsider must take. What are those basic precautions? When the outsider has not consulted the memorandum articles and the dealing is contrary to the provisions. Hey, very interesting. Here also I told you in the indoor management, you must read the memorandum articles and your contract should not be inconsistent with the memorandum articles. Have you read the articles? If the contract is inconsistent, then no doctrine will protect you. Now, for example, it is very clearly written in the articles that the managing director cannot borrow more than 50 lakhs. That's all. It is written absolutely clear. The limit is only 50 lakhs. Now, this outsider, without seeing this, he borrowed from the company cannot borrow more than 50 lakhs. The outsider gave 75 lakhs to the company. That's all. He should suffer on this balance 25 lakhs. Very clear, because you have to consult. Had you consulted the articles, you could have easily found out that lack of powers by the managing director. Second, when outsider fails to make reasonable and proper inquiries to satisfy the officer's authority. Hey, you should always not take advantage of doctrine of indoor management, doctrine and all. You outsider, you should behave like a man of ordinary prudence. Ordinary prudence means man with common sense. I'll just tell you one example. One company advertised in the newspaper that they want to sell the old ambassador car in as-is wear condition, say for 2 lakhs. Old ambassador car. One fellow who wanted to purchase this car came to the registered office of the company early morning by 7:30. At 7:30, who will be there in the office? Only Chowkidar was there. And this stupid fellow, this outsider, negotiated with the Chowkidar, come on, give me the keys, I'll go around and come. He went round and is negotiating with the Chowkidar that 2 lakhs is very high. Come on, I'll pay 1.5 lakhs. Please give the car. Chowkidar saw here and there and said, okay sir, no problem. And the Chowkidar signed all the RTA documents for Reliance Industries Limited. Chowkidar, he put all the signature and he took 1.5 lakhs cash, this Chowkidar. And then this stupid fellow, this outsider, took the car keys, took the car and went home. By the time he reached home, police were readily waiting for him to take back the car. This outsider must have common sense that who can sell the assets of the company? Chowkidar, office boys, lift operators, account assistants, other assistants of the company cannot sell the car. You get it? You should apply your mind. You should make some reasonable inquiries whether the concerned person who is entering into contract with you has authority or not on behalf of the company. What is reasonable inquiries? Depends on facts and circumstances of the case. Had you made certain reasonable inquiries, then this situation would not have come. No doctrine need to protect you. You could have easily found out. So simple common sense is, who will have power to sell the assets, the two fixed assets of the company? Only the administrative officer or managing director or some person equivalent to that. Go and find out. Am I clear? Always you should not say, come on behalf of the company, anyone signs the contract, company will take responsibility. Nothing like that. You should also have common sense, that only common sense to find out whether the officer has got authority or not. You don't have to make any detective work there. Reasonable inquiries you make. Next, had you made reasonable inquiries, this situation would not have come. Then you should make further reasonable inquiries during suspicious circumstances. Normal inquiries during normal inquiries in normal circumstances. Further reasonable inquiries during suspicious circumstances. You went to the administrative manager, same example, and he is saying that I think I have powers to sell the car. Anyway, I am not sure. Then you should not say, no problem sir, please sign. What sign? You should make inquiries. You should go to the managing director. Because there is some suspicious circumstances, some confusion. During that confusion, had you made further reasonable inquiries, then this problem could have sorted out. So there's no need for any protection for you under the indoor management. Fourth exception. When the outsider had knowledge of want of authority. Hey, when the doctrine will protect you, you honestly believed that the officer has the authority. Later on, it turned out he did not have the authority. Then the doctrine will protect the outsider. Now, when the outsider knows pretty well so-and-so officer does not have the authority, but still for reasons best known to him, he got the contract signed by him, you suffer on the contract. For example, a company gave a tender. Tender documents were released for construction contract of 5 crores. In the tender document, it was in the terms and conditions were written very clearly, the final contract shall be signed only by the managing director. The outsider must read it. The outsider knows it. Now, after the finalization of the contract, the MD went on leave for 10 days. Now, the outsider thought he will not wait for 10 days. So he went to the contract manager and told, sir, no problem, sir. You please sign the contract, sir. Contract manager is telling, Arey yaar, I don't have the powers. No problem, sir. What no problem? Contract manager signed the contract. This fellow will suffer on the contract. It all depends on facts of the case. When we can prove, when the company can prove very clearly that the outsider knows so-and-so officer does not have the powers to enter into contract, still he entered into contract, outsider will suffer on the contract. No doctrine will protect him. The next exception. In case there is forgery, the company cannot be held liable. Very important. Listen very carefully. You all read, forgery will not give you better title. Stolen goods will not give you better title. In stolen goods, what really happens? Probably the possession has come to you. Ownership has never come to you. Ownership remains with the title remains with the other person only. So like that, stolen goods will not give you any better title. This you must remember. This you must understand. So likewise, let's take one example which was given in the case law, Reuben versus Great Fingal Consolidated Limited case. Please listen to me. There was an investor. He invested in the company. When the company came out with some public issue of shares, he invested, let us say, for example, say about 1 lakh. Somehow, his application money was misplaced by the bank or some confusion happened. So he did not get any allotment or refund order. Almost after 4 or 5 months, when the outsider grew suspicious, he went to the company secretary and told him, sir, I paid so much money to the company. Say I paid about 2 lakhs. I have not received any allotment nor refund order. What the company secretary has to do? What the company secretary has to do? He has to verify the records and all, isn't it? This stupid fellow, what he did not do any verification. He just took some blank share certificate and filled all the details. His name, distinctive number, some distinctive number, share certificate number, all bogus things he filled up. Then he affixed the common seal of the company. Then he went to the directors and confused them. Listen carefully. Sorry. What he did, he forged the signature of both the directors. He forged the signature of both the directors. He put their signatures like that, and he put his own signature and gave the share certificate to the shareholder. The shareholder was very happy. Oh, thank you, and all that. The shareholder was very happy. Then after another 6 months or so, when the company declared dividend, he did not get any dividend. Obviously, he will not get dividend because his name never appears in the register of members. So this fellow took the share certificate and came back to the company. At that time, there was no company secretary. One managing director was there. He showed to him. The managing director, when he saw the document, saw the share certificate and compared with the records, he was shocked. This was a bogus document. Now listen. Outsider, this member tells, I don't know anything. Your company secretary has complied with the internal procedures and given the share certificate. If it's a bogus certificate, it's your problem. Doctrine of indoor manager will protect me. In normal circumstances, it would have protected the outsider. But in this case, what happened? Forgery has happened. Forgery will not give you better title. This you must understand in very clear terms. Forgery will not give you any better title. He has forged the signature. So who has to take the responsibility? The outsider has to take the responsibility. If this point is not there, what will happen? A MD's signature will be put by all the officers and the company will take responsibility. Idiotic. It cannot happen. Slightly change the example. If that company secretary, he has filled up all the document, all these details, wrong details, and he confused the directors and took their real signature. He put the common seal and his signature. Then the document will protect the outsider. Am I clear? Am I clear? So these are all internal procedures. Then the outsider will say, I am not bothered. In the given example, why the outsider is not protected? For the single reason that there is forgery involved. Similarly, this doctrine will not protect you in case of illegal or void transactions. The normal contract should be legal contract. Suppose let us say the contract was given. A contract was given for the fun of it by XYZ Limited, administrative manager, to kill 5 persons. And the total value of the contract is 10 lakhs. That stupid fellow, instead of killing 5 people, he killed 10 people, 5 bonus. And he is saying that, come on, please make my payment. And for this, administrative officer says, I am extremely sorry. These kind of contracts can be signed by managing director, Idoti. So come on, what is your answer? When the contract itself is illegal or void ab initio, right from beginning, where is the question of doctrine? So, doctrine will apply only when the basic contract was legal and valid. So, you have to write this much in the examination, that understand all this carefully. Go through my slides very carefully. This much you must write. He can ask you in the examination, what is doctrine of constructive notice? When he says constructive notice, you write only that much. Don't write other things. Or what is indoor management? What are the exceptions? Or you can give all the 3 depending on the number of marks. You have to be very brief and point-wise answers you have to give. Next. Let me go to the next topic, prospectus. Prospectus. I'll give you some background quickly. Instead of directly going into the subject as such, I'll give you some background. First, let us understand. When you go to a shop and purchase a color TV, purchasing a color TV from a shop is very easy exercise. Why? The product is in front of you. You can compare the features with the other TV. You can compare the quality. You can compare the features. You can compare the price. You can compare the standard. You can compare everything and take a decision across the table. Very easy. On the other hand, purchasing the shares of a company or subscribing for the shares of a company is very difficult exercise. Let us understand this. Why difficult exercise? Before that, tell me, why will you apply for the shares of a company? For returns. What kind of returns the company can give you? What are the various types of returns the company can give you? The company can give you good dividend, right shares, bonus shares when they have a lot of profits, and also good market value of shares. And all these are the 4 types of returns usually the company gives. Market value of shares, then dividend, right shares, and bonus shares. Now the issue. Now these returns when the company can give you, not today. That is the issue. Today, on what basis you are investing the money? These returns are going to come after 3 years, 5 years, or 10 years. So today you are investing your money on some basis. What is that basis? Promises made by the company. I would use the word, these are set of promises. Prospectus is nothing but a document of set of promises. It may happen, may not happen. So today I am investing my money looking at this 30-40 pages of what the company has told me. Hence the government regulates almost 7-8 sections are there. Their separate chapter is there in the Companies Act dealing with the topic of prospectus. That is why the Companies Act tells very clearly the prospectus must tell the truth. In New Brunswick Muggeridge case, what he says, the prospectus must tell the truth, the whole truth, nothing else other than the truth. Nothing should be stated as a fact and no fact should be omitted. Everything should be stated in strict and scrupulous accuracy. What is the level of accuracy required? Strict and scrupulous accuracy. That is the level of accuracy we want. Very simple here. Now, prospectus is a bridge. It's a bridge linking investors at one hand and the company has at the other hand. The company has nothing to lose. Please listen. Company has nothing to lose. The company has everything to gain. By issuing a false prospectus containing misstatements, company has nothing to lose. They are getting thousands of crores of rupees money for their project. On the other hand, an investor, if he is investing his precious savings and money on the basis of prospectus containing misstatement, he has got everything to lose. Now you got it? So, okay, reasonable prospects are there. So you should be very clear. It may happen, may not happen. Don't give exaggerated claims. That is the idea. Don't write in the prospectus that the company has already purchased Charminar, Golconda Fort and Salarjung Museum. And shortly the company will also purchase a Buddha statue in Tangmand also. Don't write nonsense. Now you got it? So government has a responsibility for the investors. You tell the truth. So the SEBI, of course, now come not only the registrar of companies, SEBI has got control over the prospectus. SEBI will go through whatever is stated in the prospectus, whether they are correct or not. Not correct or not, they have been reasonably presented or not, they will like to look into. And SEBI will ensure that the matters given in the prospectus are enough for the investors to involve themselves in informed decision-making process. Hey, listen, SEBI is not giving any assurance to the investor, hey, this is a very good company, you please invest, 10 rupees share will easily quote at 15 rupees, 25 rupees, 30 rupees on listing. No, SEBI is not assuring that. SEBI is only saying disclosure requirements have ensured. You read all that carefully and finally you take a decision. I am only helping you to involve yourself in informed decision-making process. Hence the importance of this topic called prospectus. Come on, see. Well, see, you should not write your own language when it comes to definition at least, because you will miss all the points. Prospectus means any document described as issued as prospectus. So you write on the compact prospectus. Excellent. And includes red herring prospectus, shelf prospectus. These two have been included now. Or any notice, circular advertisement inviting the offers from the public for subscription or purchase of securities of a body corporate. Okay, you don't write the word prospectus on a document. You use not for private circulation only, not a prospectus. Like that, some wordings you use doesn't matter. These words are of no relevance. So what is the content? It is you are given about 50, 60 pages, 70 pages of achievements of the company. Fine. and somewhere you have written one sentence that, come on, the company is going to come out to the public issue. I request all the general public to subscribe or purchase for the securities of the company. Then it becomes a prospectus. The name is not the deciding factor. The intent of the document is the deciding factor. If the intent is to get subscription, then it very much comes under the definition of prospectus. So these are the ingredients of prospectus. There must be invitation to public. Even section of public is also public. Okay, it's not given to few people. General doctors in Hyderabad or students in India. Those are all public only. It should be made by the company or on behalf of the company. The invitation to subscribe or purchase. Already we allotted shares to someone and he takes from that person, then it's not covered here. Directly or to purchase from the company or subscribe. An invitation must be for securities, shares, debentures or any other similar instrument. Okay. So these are the 4 ingredients of the prospectus. Now, what are some provisions in the Companies Act dealing with prospectus? Every prospectus must date that. Date of prospectus is very important because the facts and figures of the prospectus is relevant only with reference to particular date. Because the facts and figures are relevant with a particular date and we have to issue the prospectus within 90 days, all that is there. So the prospectus, when you issue, it should be dated. It should be signed by all the directors, not majority of directors. It should be signed by all the directors of the company and it should contain all the information and reports specified. So SEBI has fixed, a lot of SEBI guidelines are fixed, lot of disclosure requirements, all that it should be contained. Right. Then it should be approved by the board and signed with all the directors and filed with the ROC. These are the legal requirements you have to comply with strictly. It should be approved by the board at the meeting of the board and signed by all directors. Just now I told you, not even the majority, and should be filed with the ROC, Registrar of Companies. Next. Every prospectus must give a declaration of compliancy before we sign. They have to give a compliance declaration. Yes, all the provisions of the Act has been complied with, and also the SEBI requirements, the Securities Contract Regulation Act requirements, and they are not contrary with the provisions of this Act. The board has to certify. The directors have to certify. Then, and the prospectus, which has been delivered to ROC together with the required documents. You have to certify, this is a registered prospectus only, I have already filed with ROC, and the prospectus must be issued within 90 days. Why the limit of 90 days within which you have to issue the prospectus? Why the limit of 90 days? Because 90 days itself is too long a period of time. Okay, for compliances we have given. If it is more than 90 days, issue a new prospectus because facts and figures would have changed by that time. So within 90 days only, this after it is filed with ROC, it is valid. You must issue it immediately. Then, if the violation, see the terrible punishments. Company fine with 50,000 to 1 lakh. Person who knowingly issues the prospectus, look, 3 years imprisonment. Because you cannot cheat the public left and right like this. And fine 50,000 to 3 lakhs or both. Okay. Then. Now, when prospectus is not required to be issued, when you are giving to the existing members right issue, what is the right issue? Where further allotment of made, you should give it only to the existing shareholders of the company. They are called right issue. Now, why do you think for rights a prospectus is not required? Very simple. You all know about the company. You know the market price of shares. And our rights will be successful only when the issue price is less than the market price. So there's no need to spend a lot of time, effort and money and give another document. Company knows about that issue. Of course, in listed company, instead of issuing prospectus, they will issue one letter of offer of rights. It itself will contain a lot of information. Then second one, prospectus is also not required when the proposed issue is uniform in respect of previous issue. What is this? Sir, just now I came with the issue, sir. Just now. And within 6 months, 1 year, I am coming out to the issue, same par issue, and no much changes and all, no changes at all, and already it is listed on the stock exchange. Then, second time also, prospectus need not be issued. Except in these two cases, coming out to the issue, prospectus is very much required. Then section 27 talks about variation in the terms of the contract or objects. Very important. Many of the companies, what they are doing, they will write all nonsense in the prospectus. We have got technical collaboration with Chung Chung Chu of Korea. And we have got marketing agreement, this, that. So based on this, the shareholders, the investors might have applied. Then after the prospectus is issued, they are changing the terms and conditions of all the contracts. That cannot happen. That cannot happen. Whatever contracts have already been told in the prospectus, those contracts, any terms and conditions you want to change, collaboration agreement, marketing agreement, then any agreement, then all that if you are changing it, again shareholders approval will be required by passing special resolution. Company cannot vary the terms except by way of special resolution. And before passing the special resolution, come on, you should give advertisement in 2 newspapers justifying the variation, and also until that it is approved that balance money, the money which you have raised cannot be used, that all lot of provisions are there. Then you pass special resolution, but still some dissenting shareholders will be there. They should be given exit option. They should be given a right to sell the shares as per the guidelines prescribed by SEBI. So this idea is very important. In 2013, they have introduced this point very clearly. Otherwise, what is happening? As I told you, you have got a collaboration agreement. Then after the prospectus is issued, you receive the money, you cancel the collaboration agreement. Or you change many terms and conditions. So the shareholders must know, because as I told you, shareholders have invested based on these assurances. Then, what is untrue statement in prospectus? Most of the students write in the examination, a statement which is not true is untrue statement. Wrong, don't write like this. These are all technical issues. You should have read in the Contract Act that in certain cases, silence also will amount to fraud. Come back here. Upper May Friday contracts. See, untrue statement covers 3 areas. Non-disclosure, wrong disclosure, and half disclosure. Everything will amount to misstatement in prospectus. Those which are vital to be disclosed, you kept silent. That is also untrue statement. And you are given wrong statement. That is untrue statement. Half disclosure is also untrue statement. You told, instead of telling half truth, it is better to tell a blatant lie. Half truth will not help you. So non-disclosure, wrong disclosure, half disclosure, everything will amount to untrue statement in prospectus. Now listen very carefully. First one, non-disclosure. Look at the language used. Where the matter is calculated to mislead, the prospectus shall be deemed in respect of such omission to be prospectus. Untrue statement is included. I kept quiet with a very calculated effort, and the calculated effort with which I kept quiet is definitely going to mislead the investor. For example, you wrote in the prospectus that we have entered into collaboration agreement, blah, 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 and all that. But what you did not disclose is that collaboration agreement, you have not paid the second installment of 5 crores. And the collaboration agreement has already expired. You have not disclosed that. Now, the means of finance, term loan 60 crores. The company is getting a term loan of so-and-so from so-and-so financial institution. But still, the sanction letter has not yet come. That you are not disclosed. So, if you are silent also, it will amount to misstatement. Next, what is untrue statement? What is wrong statement? Look at this language. This you have to write in the examination. Whether a statement is true or not, is to be judged from the context in which it appears and totality of impression it creates. Whether the statement is true or untrue or not is to be judged from the context in which it appears and totality of impression it creates. One fellow said, "Sir, sorry, sir. 60 pages of correct statement I have given. Excellent. Sir, in one page, in the second paragraph, one wrong sentence I have written." "Okay, fine. Sir, one wrong sentence. Come on, tell me, what is that wrong sentence?" "Sir, by mistake I have written that Mr. Mukesh Ambani and Anil Ambani are the promoter directors of the company." "What? One small misstatement. Stupid fellow, because of this sentence, your whole issue was subscribed 10 times. For that one misstatement, one sentence, you will be given 3 years full imprisonment." Now you get it? Whether the statement is context in which it appears. You are saying the top industrialists are the promoters and the impression it creates. You didn't make some mistake in typing the address of the promoters 2-3-7-442. That you made some mistake. That doesn't matter. Context in which it appears and totality of impression it creates. It shall be untrue statement if it is misleading in form and content. Half disclosure is no better than blatant lie. Listen, what is this? In one company, a company made a statement. "We have paid in the last 5 years consistent dividend of 20% in the last 5 years. What? What impression the shareholder will get? Oh, the shareholder will get an impression. Oh, they have already paid dividend. That means what? The project is already set up. Commercial production has started. And it is well established in the market. They have earned the profits. Hence, they have paid dividend." Everything goes into his mind. So they have paid a dividend, that too consistently for 5 years, 20% is a very big amount on the investment. But what it later turned out is, they did not pay dividend out of profits, they paid out of revaluation reserve. Stupid fellow, what they did? Every year they used to revalue the asset. And they paid the dividend out of revaluation reserve. The company has not yet started production. No question of profits, no revenue profits. Real. Telling half-truth is better than blatant lie. No better than blatant lie. If you are told a lie, that would have been fine. In order to prove misstatement, 4 points you must keep in mind. The misstatement was a fact. Not in opinions and all, in a fact. And that was a material fact. I gave in my example, Mukesh Ambani, Anil Ambani, the promoter directors. Material fact. And the investors have acted on the misrepresentation and investors have suffered the damage. All this you have to prove in misstatement. Then the golden rule, as I already told you. What is that golden rule? The directors hold out to the general public that great advantages are likely to accrue. So, this holding out caste, they should state the facts honestly and faithfully. They should not abstain from stating something as a fact, and they should not omit the fact which they do not know. So, as I told you, the public is at the mercy of the shareholders. Public is at the mercy of the company. So, if they tell untruth, they will lose a lot. This is what I told you. The prospectus must tell the whole truth, nothing else other than the truth. Then next issue. Then falsehood and dividend paid out of reserves, I told you. Now, come on. Who can be sued in case of misstatement in prospectus? Who can be sued? Look at the fun. Who can be sued? Lifting of corporate veil. Normally, who has issued the prospectus? Company. For whose project the prospectus was issued? For company's project. Then who is receiving the money? Company. Who is using the money? Company. But who is punishable? Not just the company. The company, every director, every person whose name appears in the prospectus, every promoter, every other person who authorized the issue of prospectus. Why all are punishable? Then all the people will be careful. Prospectus is not written by the company by themselves. It is written by directors and other persons. So put them behind bars. So they are also punishable in case of misstatement in prospectus. So all these people will be careful. They will not promise, as I told you, Salajan Museum, Golconda Fort and all that, they will not promise. Every expert also will be liable. Now, for mistake in prospectus, two types of remedies you have got. Civil remedies, civil liability, criminal liability. For the same offense, it will be treated as civil offense as well as criminal offense. So, let's do one thing. First, you will sue the company and you can also sue the directors and all that. So, you can sue the company and all the directors and all. Now, you have two remedies. Against the company, what are the two remedies you have got? Rescind the contract. If you can prove that there is misstatement, sir, please cancel the allotment of shares made to me. Please refund it. And you can also sue the company for deceit, cheating, damages. But generally what we do, we'll sue the company only to rescind the contract. For damages, we'll sue the directors and others because usually you get more. Then, what is the criminal liability against the directors and all these people? I told you civil as well as criminal liability. So first one, every person who authorizes the issue of prospectus will be sued for fraud under 447. In 447, you know what is the punishment? Imprisonment not less than 6 months, extending up to 3 years. Misstatement. Extending up to 10 years, and fine 3 times the amount of fraud. 10 years up to which imprisonment can go on in the criminal liability under section 34. What are the defense available? One is statement omission was immaterial. So what is the defense available to director? Okay, sir, I made the mistake, but in some address or something, really he did not lose. Or he had reasonable grounds to believe and did believe the statement was true. Sir, I still believed it is true, sir. Suppose, let us take one example. The company has written the prospectus, we had 100 acres of land. Now, just 10 days before the issue of prospectus, the MD and company secretary sold 5 acres of land illegally. The company is not aware. The matter was not brought to the board. So making all other directors responsible may not be correct also. So you have to prove, the director proves that I had reasonable grounds to believe. నేను నమ్మాల్సిన కారణాలు ఉండింది అందువలన నమ్మాను. I had reasonable grounds to believe and did believe that the statement was true or the omission was necessary. These are some defenses available to you. Similarly, for civil liability, whom you can sue, the director, any person who authorized the issue of prospectus, the promoter, all these persons can sue. For compensation, you can sue. For every person who has sustained the loss or damage apart from the criminal liability, you can sue them. And also, any person who was to defraud without any limitation liability, you can sue them. What are the defenses available to these people? One, having consented to become director, withdrew the consent. Hey, listen very carefully. Sir, I was a director long back. Before the issue of prospectus, I have already resigned. So I never knew the prospectus was issued. Then how did your name appear in the prospectus? That depends on facts of the case. Maybe signatures were forged and someone has written the name. We'll not go into that. He is trying to prove before the court, I was not a director at the time when the prospectus was issued. I've already resigned. Then obviously cannot be made liable. Second, prospectus was issued without his consent on becoming aware. He said that I was a director, but I never went to the board meeting. I never knew that the company has issued prospectus. I have not signed the prospectus. They have forged it. Then obviously you should not make liable. These are the defenses. Expert statement in prospectus. See, normally, for example, I'll tell you, recently one company went with a public issue, cement company. They said in that they have technical collaboration agreement and they got a rotary process in manufacture of cement. The rotary process is very good technology. One cement technologist, an expert, gave one paragraph in the prospectus, greatness about rotary technology. Much of the subscription was made because of that sentence about the greatness of the rotary technology. Fine. So that expert also, when you are given the statement, you will also be liable. So experts are chartered accountant, cost accountants who give about the benefits of investing in the issue in terms of income tax, all that. So consent of the expert must be obtained. And the expert should not be connected to the promotion or formation of management. Now, when expert will not be liable if you have given the consent and withdrew the consent, but sometimes you came to know of the, after issue of prospectus, you came to know about the misstatement, you give public notice for withdrawal, then you will not be liable. So punishment under the Companies Act, you see, for fraud, any person guilty of fraud, 1 lakh or more the turnover will be punished with, see, just now I told you, 6 months to 10 years. And public interest are minimum 3 years punishment. And the lower level of frauds will be tenures 5 years up to imprisonment and fine 50 lakhs or more. This was about the prospectus. Now, the third topic which was given to me is the issue of shares with differential voting rights. Issue of shares with differential voting rights. One is called equity shares with voting rights. Don't say equity share without voting rights. That's not the proper presentation. We should call it equity shares with the differential rights with respect to voting and dividend. What is this shares? Listen very carefully. They are nothing but the equity shares. Only one sentence you must fix in your mind is, for the sacrifice in the voting rights. Suppose I've got 100 equity shares. One vote I will keep. 99 votes I will sacrifice. For that I will be paid extra dividend. How much extra dividend? 2%, 3%, whatever is given in the articles. That's all. Equity shares with differential rights means it's nothing but equity share in all respects. The only difference, as I've been telling you, is for the sacrificing the voting rights, come on, I'll be paid extra dividend. That's all. Now let me give you some background. Now the Companies Act has worked out so well, 1956, prior to that 1912, for almost 150 years plus. The Companies Act has worked out very well. You had only equity shares with voting rights. What really happened in the economy, which necessitated the government to come out with equity shares with differential rights with respect to voting and dividend. Now, my first issue. Why should the company burdened with 2-3% extra dividend? Why should the company bother whether they sacrifice the voting rights or not? First, I'll tell you the background. Quickly, I'll tell you the background. If you look at this 15,000 listed companies in India whose shares are quoted in the stock exchange, which is the core of the industrial development of the country, 90% of these companies are run by first generation promoter. What do you mean by first generation promoter? Means they are not born rich people. Reliance Industries Limited, Dhirubhai Ambani is a first generation promoter. Whatever little money he had, he has already put in the shares of the company. Infosys is a first generation promoter. Narayan Murthy is not born rich. Whatever money they had, they already invested in the company. So like that, 90% means what? Out of 15,000 companies, 13,500 companies are run by first generation promoter. And now they are doing very well. So when the first generation promoter puts money, the problem is they would not have more than 10%, 15% of the shares. Because where is money? So most of these 13,500 companies, first generation promoted companies, the promoters are holding hardly say 10%, average let us say 10% of the shares. Rest 90% who is holding? Collaborators, NRIs, general public, banks, financial institutions, mutual funds, mutual funds, foreign institutional investors, the list goes on. Then with just holding 10% company, how you are able to run the management? If you want to run the management, you must have 51% support. With the support of the public and all these people, they are running the show. I repeat, this is not the story of just one company, two company. It is the story of 13,500 listed companies in India. Right. Issue number 2. If you hold only 10% shares, fear of takeovers. Fear of takeovers. Because any group can acquire 11% shares in the open market. He will also have the support of other people and he will take over the management. Mergers, amalgamation, takeovers is the order of the day. Lot of takeovers, and SEBI, Companies Act and SEBI guideline does not prohibit takeovers. They only regulate the takeovers. You have to follow certain rules. Very simple here. Infosys can be taken over. If 1 rupee share is quoted, just example, say 1,500 rupees. If someone is prepared to offer 1,700 rupees in the market, come on, general public will sell to him. It could be anyone's game. You got it? So, please listen very carefully. The promoters, the management of 13,500 companies are living in fear of takeovers. Now, they can't increase their shareholding. How? See, where is the money here? Whatever money has got, I've already invested. The fear of takeovers. You cannot help it. Issue number 3. Now, business operates in dynamic environment, not in static environment. All these 90% first generation companies are doing very well now. They want to go for expansion, modernization and diversification. They want to go for expansion, modernization and diversification. Good. You want to, so let's take the case of Infosys Limited. Let us say the authorized, the issued capital, just imagine the figures, 10,000 crores. Let us say Narayan Murthy is already invested face value 1,000 crores. They want to go for expansion, another 10,000 crores. Fine. So for another 10,000 crores, come on, Narayan Murthy has to invest 10%, 1,000 crores. Where will Narayan Murthy get the funds? Are you understanding? See, whatever money Narayan Murthy has got, he is already invested in Infosys shares. He may be worth market value 15-20,000 crores. But where is that money blocked up in the shares? Apart from that, he has got one house, one car and 2 lakh rupees bank balance. That's all. So if you ask Narayan Murthy to invest further 1,000 crores, not possible. Are you getting my point? Already Narayan Murthy is not sleeping because his holding is only 10%. Anytime takeovers can take place. Now what the problem is, if they go for expansion, now okay, this 10,000 crores, if Narayan Murthy is not investing 1,000 crores, public will invest. But see the percentage now. On 10,000 crores, I was holding 1,000 crores, 10%. On 20,000 crores, my percentage of shareholding 1,000 crores will come down to 5%. Are you understanding? So if I go for expansion, modernization, diversification, my overall holdings will come down much below. Already I am not sleeping when I had 10%. Imagine my position if I hold only 5% of the shares. Now you got it. So my concluding sentence, this 13,500 listed companies, first generation promoters, they are saying will not go for expansion, modernization, diversification. What? Industrial growth and development of the country is coming to a standstill. My God, government realized this. The answer is the equity shares with differential voting rights. Come on, how it will solve the problem? First, promoter. Because these shares will not have voting rights. They are sacrificing the voting rights. So promoters are very happy. Are you clear? Without further investments, come on. Their 10% shareholding, in my given example, they are maintaining it. Second, other investors are also very happy. Small investors, banks, financial institutions, they are happy because everyone is not interested in takeover. No one is interested in the management. They are getting extra dividends. They are quite happy. Third, company is also happy because they are getting funds for They're getting funds for modernization, diversification and all. Wonderful. Okay, for that you have to pay extra dividend, 3-4%. Wonderful. Company is happy, small investors are happy, promoters are also very happy because there's no voting rights. So in this background, you must read. So what are the guidelines? To whom I will give this facility? First, in the rules, simple rules have been given. I'll give this facility to public companies and private companies. What are the conditions subject to which I'll give the facility? The articles must authorize the issue. Fair enough. If there's no provision in the articles, you must amend the articles. Second, shareholders' approval are to obtain by ordinary resolution. Even if you have provision, now you are going for that. You cannot bypass the existing shareholders. Take their consent. If it's a listed company, postal ballot, so that everyone can participate. Now, the most important point. It should not exceed how much you can give. We don't want too much of these kind of shares. Too much of equity share without voting rights is also very dangerous. So how much you can issue? Not exceeding 20% of the post equity. Fair enough. If 100 crores is your equity, 100 crores is equity with voting rights, further you can issue how much? Only 26 crores. So balance for the project cost, you take term loans, debentures and all that. Next, the company should have consistent track record of 3 years. As I already told you, this facility is given to those companies only for expansion, modernization, diversification. You require further money for growth. Loss-making company going for further expansion. Nothing doing. So you need not have declared dividends, but if you want, you should be in a position to declare. You should have distributable profits for the last 3 years. And I will give this facility only to law-abiding companies. I'll give this facility only to law-abiding companies. What is law-abiding? You are not defaulted in filing the financial statement, annual returns for 3 financial years preceding the current financial year. Come on, file all this. The last 3 years, balance sheet, annual returns, all that with the ROC, financial statements. And the company has not defaulted in the payment of dividends to shareholders, mature deposit, redemption of preference shares. Hey, law-abiding company. You run the company properly. Creditors are to be protected. Come on, whenever declared dividend has been declared, pay it. Don't withhold it. Deposits, the interest has to be paid on time. On maturity, that has to be paid. Preference shares, dividends, debentures. So, law-abiding company. Next, company has not defaulted on the payment of dividend to preference shares or term loans to public financial institutions, banks, and statutory payments to employees, ESI, PF, all those payments. And also any amount to be deposited investor education protection fund. So the last 3 points are nothing but law-abiding guidelines. I'll give this facility only to those people who do business without any default, complying with law. And also, this is also law-abiding. You should not be convicted in the last 3 years by any RBI Act, SEBI Act, Securities Contract, Foreign Exchange Regulation Act, and other special acts. Very good. Sectoral regulators for insurance company, IRDA, Insurance Development Regulatory Authority, those people's directions also should have complied. Fair enough. You are doing business in the most honorable manner. No defaults. You take this benefit. Then, you should not convert. Very important. What is the purpose of this equity shares with differential voting rights? The purpose is to mobilize further capital. So if you allow conversion, what will happen? Existing capital itself, they will convert and the very purpose will be defeated. So no conversion. You have already issued equity shares with voting rights, that will remain. And equity shares with differential rights, if you issue also, that will remain as it is. You cannot interchange each other. That's it. And you have to maintain a separate register of members which contains all these details. That's all here. Major guideline is only 2 points. Rest are all law-abiding guidelines. What are the major points? One is you should have distributable profits for 3 years. And second point is total issue should not exceed 26%. That's all. Rest are all law-abiding guidelines. Go ahead with that. And one more thing is, listen, they are not separate category of shares. They are your regular equity shares. And all the equity shareholders will have 36 rights. Here, one right he will not have. What is that right? He will sacrifice. Only one vote he will have. For sacrificing the 99 votes out of 100 votes, he will be paid extra dividend, 2 or 3% as specified in the articles. It will also have market value of shares. Here, how it will be quoted higher? Market value, how it will be quoted higher? Very simple. Regular equity shares are quoting at 1,500 rupees. This will quote at 1,550 because you are getting more dividends. This is the guideline. We will now move on to buyback of shares. We'll now move on to buyback of shares. Listen very carefully. Same question. When section, even now you have got section 67 which says the own shares to protect the creditors. Why we are very careful? Because creditors are already suffering because of limited liability. If you allow buyback, shareholders will be paid their amount out of the assets of the company, then nothing remains, and what the creditors will get, buckets and broomsticks only. Limited liability is a hanging sword. Already they are suffering. So in the event of liquidation, first the creditors are to be paid. So then only equity shareholders, preference shareholders has to be paid. So when still you know that, still when you got a guideline that the company cannot purchase its own shares, then why you are allowed to buy back? I'll give you the brief background. Just now I told you 90% of these are first generation companies. And I told you in first generation company, very easy to do buyback, very easy to take over. I gave an example. The promoters are holding 10% shares. If you offer at a higher price, then they will also give you the balance shares. And the company could be anyone's game. I'll take one example of Rasi Cements Limited takeover. I was working in that company about 25 years back, yes. And this takeover episode, though it happened some 25 years back, it appears to me as if it has happened yesterday. B.V. Raju was the promoter. Great man. He's no longer living now. He was a Padma Shri awardee. He was chairman of Cement Corporation of India. Then he set up his own group of companies, Rasi group of companies in Hyderabad. The shareholding pattern those days of Rasi Cements was something like this. B.V. Raju and his wife was holding 11% shares. And the B.V. Raju has 3 daughters. The daughters, son-in-laws, they were holding 14% shares, 25%. Then this APIDC, Andhra Pradesh Industries Development Corporation, they were holding about 10% shares. Then IDBI was holding another 10% shares, 45%. And general public was holding 55% shares. Great. I was a company secretary for some time. Thereafter, I left and set up practice. But still, I was a consultant to that company. One great man, those days no SEBI guidelines and all that. One great man made an effort to take over Rasi Cements Limited. All of you know who is that great man? Chennai Super Kings, Mr. Srinivasan, managing director of this. He had his own cement company. He wanted to take over. His eyes fell on Rasi Cements Limited. He was MD of India Cements Limited. Because Srinivasan felt that in the South India, there were 2 major companies. And the production facilities of Rasi Cements was very good. The marketing facilities of India Cements were already there. Whatever it is, 10 rupees share was quoting at 70 rupees in the market those days. Srinivasan slowly started purchasing all over India in stock exchange, about 10% of the shares in the open market. He spent hundreds of crores of rupees and slowly purchased in different names. Different names he started purchasing all the shares. Fine. After having purchased this 10% shares for so many hundreds of crores, it is worth converting into a movie If anyone is prepared to take a movie, I'll give the story free of cost. It has all the ingredients. And second one, then what happened? One day he came to Hyderabad by the morning flight. He directly went to B.V. Raju's son and went to son-in-law of B.V. Raju at 10 o'clock in the morning, because he knows B.V. Raju will be in his office. So he went to their residence, the three son-in-laws. He told them very clearly, look, no beating around the bush. I understand you people have got 14% shares with you. Market value is 10 rupees, 70 rupees. I'll give you 90 rupees. Come on, straight. So many hundreds of crores. Story is over. All the three fellows signed the document without telling the father-in-law. This is life. No father, no mother, no brother, no sister. That's all. Paisa, paisa, over. Hundreds of crores of rupees. That's all. They put the signature. Story is over. So how much this fellow is having? 10 plus 15, 10 plus 14, 24%. He went back to his hotel. This APIDC, the one corrupted financial institution, he paid some money and all. 10% shares they also transferred. That's all. Bindas, 34% shares he is having. No one can touch him now. In the evening, he went to Rasi Cement's office. B.V. Raju, an old man, at that time he was aged around 70. He was sitting in his cabin. Straight away, Srinivasan entered inside. B.V. Raju knows him because they are all members of South Indian Cement Association. So B.V. Raju told him, come on, my dear young boy. Srinivasan was a young boy at that time. Come on, my dear, how is that you have come to see the old man? Srinivasan said, sorry, sir, I have not come with some good news. Sir, I'll straight away come to the story. Sir, your game is over. 10% shares are purchased in the open market. Then 14%. Son-in-laws have sold it to me. Probably you are not aware. Third, APIDC has given. Sir, I am having 34% shares. If you also give your 11% shares, I'll be very happy. I'll purchase at 100 rupees. I don't know how you are feeling. It happened some 30 years back. I am feeling as if it is happening now. Here is someone coming in front of you and telling, please cut off your hands and legs and give it to me. B.V. Raju spent 5 years, heart and soul, to set up such a beautiful factory. Every brick in that factory will speak of this great man. Here is one man coming and saying, the story is over. B.V. Raju said, get out, this, that and all. Then Srinivasan said, as I can understand your feeling, anyway I have no option. He went away. Then B.V. Raju called all these close confidants and all. Overnight they were discussing. Now he said, I want to retain the company. Now look at the game plan. If B.V. Raju wants to retain the company, he is holding how much? 11% shares. IDBA was supporting 21%. Already that fellow is holding 34%. 10 plus 14, 24 plus 10, 34% is holding. So this man is holding 20, the 11 plus 10, 21%. If he has to retain the company, he 15% from shares in the open market tomorrow. And already Srinivasan is going to come to the open market tomorrow and to purchase more shares at 100 rupees. So you have to offer 120 rupees at least to attract the investor. 110 or 120. 110 rupees, 15% shares means overnight you should have thousands of crores. Where from you will get the money? And even if you mobilize the money and purchase the market, then what happens, you see? Okay, you purchase the shares, you retain the company. But then this 110 rupees is not a correct price, inflated price. Tomorrow the price after Srinivasan only will sell the shares. He has made a lot of money. He purchased the shares at 60 rupees average. He will only sell the shares. See, both ways Srinivasan will gain. So then this man, after purchasing at 110 rupees, his shares value will come back to 70 rupees. He will lose 400, 500 crores straight away in the transaction. So midnight, after midnight, that's a midnight takeover. B.V. Raju called me, Jayaraman, go and bring that man from the hotel. 3 o'clock I brought him. And P. Raju said, he got up from the seat and said, sir, I'll give my 11% shares. As promised, you give me 100 rupees per share. Then he got up, asked him to sit in it was pathetic scene. And he was so upset with his family and all, he called his wife, he went to Bhimavaram, and rest of the life, he spent all the money on colleges and lot of social work and all this, that. And he died basically. Why I gave this background is because this is not the isolated story of Rasi Cements Limited. This is the story of 13,500 listed companies. I used to give example of Airtech and Takeover. Now it is converted into a movie also recently released. Go and see the movie. Not now, after the exams are over. Not now. Takeovers, hostile takeovers. Now, Viraju told me at that time, it is only because of the stupid section 67 which prohibits purchase the shares, because of which this has happened. What that section 61 says, company cannot purchase the shares. Viraju says, hey look, can't have money. Company had surplus profits. If you have allowed buyback, what would have happened? This floating stock which is available in the market, company will purchase and cancel it. Are you getting me? Company will purchase and cancel it. Then Srinivasan would not have had this floating stock. Got the point? So lot of, see, Viraju cannot mobilize money overnight, but company had money. They had lot of profits. They have lot of balances. So the government thought about it, because foreign investments are now coming in a big way in the country. Therefore, lot of floating stock is there in the market. They will purchase. So let the companies purchase their shares and will cancel. But at the same time, we'll put effective safeguards. Second reason, just example I am giving you, Reliance Industries Limited. Let us say, there also lot of equity as issued. The figures are not correct, only understanding purpose. Now let us say, Reliance Industries Limited, equity is 25,000 crores. He is paying 100% dividend. Yes, he is earning so much he is paying. So what is the outflow of cash after tax? 25,000 crores. Stupidity, isn't it? From the company's point of view, see what is the cost of funds. From the company's point of view, please see, 1 rupee invested in the company, you are giving 1 rupee back. 100% is the cost of funds. Are you getting my point? Dhirubhai Ambani, when he was alive, now Mukesh also says no compromise on dividend. We are earning, so shareholders have trusted, we'll pay dividends. But then from the company's point of view, from prudent investment point of view, if you see, 1 rupee invested in the company, you are to give some 15% returns is reasonable. You are giving 100% returns. Now Mukesh says, 25,000 is the equity capital. If our Companies Act allows me to purchase some of the shares, I'll purchase those shares and substitute with the debt funds. Are you getting me? Say 5,000 crores, I'll purchase the equity and replace it with loans from banks, financial institutions. Loans to banks, financial institution, what is the rate of interest I have to pay? 13-14% only, and their interest is tax deductible. So effective rate of interest will come to 12 to 13%. Whereas here in equity, how much is the outflow of cash? 100%. You are getting the points? Like that, there are a lot of reasons why the government should allow buyback. But one thing, the creditors are to be protected. So lot of precautions are taken, and then we will allow buyback. Buyback is not a matter of routine. Buyback will be allowed only in extraordinary circumstances, when all the process and procedures you follow. Is that clear? Come on. First, sources of buyback. Buyback will be allowed only out of free reserve securities premium proceeds. Listen very carefully. In redemption of preference shares also, this point will be there. Listen, working capital cannot be used to redeem your shares. Long-term capital cannot be redeemed with working capital. So what is he saying? In the liability side in the balance sheet, free reserves, P&L account, securities premium, general reserve. What is free reserves? Undistributed profits belonging to the equity shareholders. So don't use borrowed money to return back. So this, what you have to do, we have to create CRR, capital redemption reserve. So from this, what do you understand? You are not using working capital, you are using only the reserves and surplus to return the money. Fair enough. You are not using working capital, you are not using borrowed funds. So profitable companies only can go for buyback. Fair enough. Or of proceeds of fresh issue. In proceeds of fresh issue, what happens? We are not touching the working capital. You are going for further equity or preference shares. That money comes inside and this money used to redeem the equity shares. And no buyback can be done out of the proceeds of earlier issue. Then, if the shares are purchased back, buyback after free reserves, you have to create CRR account. Now you read all the CRR account in preference shares also. And the capital redemption account can be used not for the payment of dividends. So it can be used only for one purpose. What is that? For issue of bonus shares. Fair enough. Fair enough. These are all to protect the creditors. These are all the guidelines to protect the creditors. To ensure that working capital is not used to redeem the long-term liability. Then, conditions of buyback. The buyback must be authorized by articles. If there is no provision in the articles, amend the articles. Unless special resolution has to be passed. You can't bypass the shareholders. Special resolution, overwhelming majority, number of votes in favor should be 3 times the number of votes against the resolution. So you pass only special resolution, then only we'll allow buyback. Tell the shareholders what is the use of buyback. Then after the buyback, what is our likely price, how our share value will go up, all those things. Then, the buyback is less than 25% of paid up capital and free reserves. However, in any financial year, it should not exceed 25% of the paid up capital in that financial year. Very important, please see. When my paid up capital is 100 crores, total buyback over a period of time, 3 years, 4 years, 5 years, can I do 100% buyback? Yes. Don't be misled by the first sentence. The buyback should not exceed 25% of paid up capital and free reserves. Look at a situation when the paid up capital is 100 crores, free reserves is 300 crores, total 400 crores, 25% of 400 crores is 100 crores. The more the free reserves you got, the more you can do buyback. So technically, for your understanding, if the free reserves is 3 times the paid up capital, you can even go 100% buyback over a period of time. But no fellow will go for 100% buyback. Harihar, if you go buy back all the shares, then how will you run the company? With what money you will purchase fixed assets and all that. So we go for buyback up to 10%, 15%, 20%, as I told you, only to purchase the floating stock from the market. Having said that, so technically can go for 100% buyback over a period of time. He says per financial year, it should not exceed 25% of paid up capital. Only paid up capital. 25% of paid up capital. Slowly go for buyback. At a time, per year, 25% of paid up. Now don't come to a conclusion in 4 years. No, reducing balance method, it will never come to 4 years. Am I clear? So this is the most important guideline, that you, out of the profits of the company only, you go for buyback, and total buyback should not exceed 25% of paid up capital and free reserves. The more 3 times the free reserves you can go. Per financial year, it should not exceed 10%. Then, if special resolution is passed, how much you can go for buyback? 25% I told you. For any reason you are not able to pass special resolution, you don't want to pass the special resolution, then the board of directors themselves can do the buyback. How much? 10% of paid up capital free reserves in 1 year. Fair enough. Suppose you have an apprehension, you have got a feeling shareholders may not agree for buyback, special resolution difficult to obtain, number of votes in favor should be 3 times number of votes against. Then in that case, smaller quantity of buyback you want to do, let the government themselves can do. Let the board themselves can do up to 10% of paid up capital. Fair enough. And this is the most important guideline. The debt equity ratio after the buyback should not exceed twice the capital and free reserves. Of course, the government may prescribe a higher ratio. Government has not yet prescribed any higher ratio. Listen very carefully. Practical implication, please see. Debt. Debt means what? Borrowings, debentures, loans from banks, financial institutions, deposits. These are all debts. Equity means what? Equity means equity share capital, preference share capital, reserves or surplus. Listen very carefully. Debt equity after the buyback should not exceed twice the capital. These are to protect the creditors. I'll tell you how. Listen very carefully. Now let me take one example. The equity is 100 crores. Equity is 100 crores. If you do some analysis of all the 11 lakh companies in India, private public companies, I find debt equity 5:1 today. Our term loans itself, government gives you 2:1 debt equity. 1 rupee if you bring money, 2 rupees government, the banks will give term loans. Then what about debentures? What about deposits? What about working capital? So on an average, I now find 5:1 is the debt equity today. Ante ardhamaindi, what do you understand? 1 rupee invested in the company, how much they have already borrowed? 5 rupees. 1 rupee invested in the company, come on, how much they have already borrowed? 5 rupees. Means they are already doing business with creditors' money. పెట్టుబడి చాలా తక్కువ పెట్టాడే వాడు బయట తీసుకున్న అప్పులతోనే బిజినెస్ రన్ చేస్తున్నాడు. Debt equity is 5:1. For example, this is only an example. If the equity is 100 crores, debt is already 500 crores. Keep it aside. ఇప్పుడు ఏం చెప్తాడు? Debt equity after the buyback should not exceed 2:1. Ante 100 crores is the equity. Let us say 25 crores we are doing buyback. So after the buyback, equity will be how much? 75 crores. 2 times debt anta 150 crores. Means after the buyback, 150 crores kanna debt undakodu. Means what? It means already you got 500 crore debt. So before doing the buyback, 350 crores debt to bring to that 150 crores. Ye masaka. 350 crores from where I will pay the money? I mean that. I thought I've got some surplus money, 10 crores, 15 crores, I'll do buyback. No. Come on, you sell your fixed asset. If I sell my fixed asset, how do the business? Ante buyback ani em jaragadu. Buyback. Equity-based company only to some extent you can do buyback. So creditors are to be protected. How can you return the share capital? When you got debentures, when you got deposits, when you got borrowings from banks, financial institutions, when you got working capital, their interest is to be protected. Varna udilisi, buyback mante elagaya? Yes, sardaga unda. So debt equity after the buyback should not exceed 2:1. So practically when you run, very difficult for the companies to go by buyback. These are the most important guidelines. You should understand the practical utility. Next, all the securities must be fully paid up. So partly paid up means you make the balance calls and all that. Then, these are only basic guidelines. Other procedural guidelines are also there. For listed companies, SEBI has issued the guidelines you have to follow. Unlisted companies, government guidelines. They are only procedures you have to follow. Then, other conditions. Buyback should be completed within 12 months from the date of passing the board or special resolution. Now my question is, why 12 months time? Why 12 months time? If you have got enough money, go to the stock market and purchase the shares and finish off. If you go to the stock market and purchase your own shares under buyback, what will happen? You want to purchase 10-20% shares. You have got huge money. Market will be disturbed, isn't it? Demand supply factor will be disturbed. Supply in the market is very less. Suddenly demand goes up, price will go up. And the company, stupid people, they will end up purchasing their own shares at a higher price. No. Go and sit in the open market. Slowly, without disturbing the price, without seeing because of you the price gets increased, don't see. Whenever some people sell their shares, slowly purchase it. So 1 year time is given to you. There is no urgency to do the buyback immediately. You get it? Next. The explanatory statement should give. Just now I told you, if you are going for 25% buyback, how much? Come on, if you are going for 25% buyback, then the special resolution is required to be passed. When the shareholders are passing the special resolution, provide them with all the information of full disclosure of material facts in the explanatory statement, so that shareholders will take a decision based on informed decision making, not blindly pass the resolution. Understand the implication. What is the present position? What is the likely market price after buyback? Other details. Educate the investor. Third, buyback is permissible. What is this? You can't climb the rooftop of the registered office and shout buyback. No one will come and surrender. There should be a method of buyback. How do you do the buyback? 1. From existing shareholders or proportionate basis. This is not popular method. You send the notice to all the shareholders. Out of 100 shares, you will purchase 25 shares. It will disturb the market lots. It's very costly, not popular. Forget it. Second, from the open market. Beautiful. This is the best method of buyback. Just go to the stock market like any other investor and sit there. Any person who sells the shares, please purchase. Third, by purchasing the employees shares, sweat equity or stock option. From this, what do you understand? Selective buyback is not allowed. You cannot buy back in a selective manner. You cannot buy back in a selective manner from the banks or financial institutions and all. If at all any selective, because when you buy back, you pay a higher price, isn't it? That offer should be given to all the shareholders. If at all selective buyback is allowed only from the employees. So these are 3 methods by which practically you do the buyback. Then, after you finish the buyback, you have to file the registrar and SEBI a declaration of solvency. What is solvency? My assets are more than liabilities. After the buyback, suddenly you go for winding up and all, creditors will lose. So tell them very clearly, even after spending all this money, even after buyback, my assets are more than liabilities. Declaration of solvency you have to file. Then, when the company buys its own security, they should extinguish and physically destroy within 7 days. See? Of course, online, the dematler, there's no problem. If their physical shares are there, they may be misused. Some fellow may again sell it in the open market. We don't want all that to happen. Come on, cancel all that shares, tear it off, burn all the share certificates so that frauds cannot happen. Then, no further issue shall be made within 6 months. Arey, why did you go for buyback? Thinking that you went for buyback, thinking that we have got surplus money, we don't require it. Then again you are going for further issue for future projects, then stop your buyback. So anyway, within 6 months, if you are going to go for expansion, don't go for a buyback. Except this bonus issue and all, there is no outflow of cash conversion, those cases. Then company should maintain one register of buyback. All the details are to be written and the necessary returns are to be filed with ROC as well as SEBI. Next section. No company can directly or indirectly purchase their shares through subsidiary or investment companies or, what is this? Very simple. Let's take the case, Nagarjuna Finance Investments is there, Nagarjuna Cements is there. If Nagarjuna Cements is going to purchase back the shares, hell a lot of guidelines they have to follow. Instead, what they can do very smartly, they'll use the money of Nagarjuna Finance Investments and purchase all the shares of Nagarjuna Cements. No, not permitted. You cannot use to purchase the shares through the subsidiary company, investment company, group companies and all. Or if default is made, same. I will give this facility of buyback only to law-abiding companies. I have to protect the creditors of the company. I have to invariably protect the creditors of the company. So, come on. First, if there is any default in the payment of interest or redemption of debentures or redemption of preference shares, payment of dividend, repayment of term loans, interest to banks, financial institutions, suppose there is a default, you have rectified it. After 3 years after rectification only, you can go for buyback. Not that you will rectify today and go for buyback tomorrow. See, if the default is remedied in 3 years has elapsed. So after you rectify the default, after 3 years only you can go for buyback. As I told you, these are all to protect the interest of the creditors of the company. See, like that you must read here. You must understand the points and just go through. Then you will enjoy the examination. Then you will remember, just by hearting will not help you in any way. Conceptual understanding of the subject. Point wise he is asking in the examination. In the paper you see most of them are 2 marks, 3 marks papers they are setting. Apart from that, today you have got objective type, multiple choice questions also. So therefore conceptual, by heart you will not. Then in case they are not complied with the annual returns they are not complied with. That is, you are not complied with section 92 or 123 declaration of dividend, you have not filed the financial statement to ROC, then also you cannot go for buyback. So this was the extensive discussion I think we had on buyback of shares. So before I conclude, I wish you all the succession of success in your examination. So all the succession of success in your examination. So examination will be conducted on time. Don't panic. Calmly write. Last minute you don't have to revise 100%. Whatever you have revised, that is sufficient. Be confident. Don't unnecessarily take new topics and panic. Panic is the worst thing. Confidence is something that is very much essential. Confidence is something that is very much essential. Then go on time. 15 minutes before the paper will be given. Read the paper very carefully. And you got lot of time